I think it's fair to say that we all want to be better investors. Or more specifically, we want better returns. It's common to think that the only way to get the best returns possible is by picking the perfect portfolio filled with the funds that have the best performance. However, in February of 2019, Vanguard updated some of its research, which quantified the added value that financial advisors can provide to their clients. They identified 7 key areas, or modules as they put it, in which value can be added or returns can be boosted. I bet that 99% of the people watching haven't even considered some of these areas of portfolio management. So hopefully we can all learn something by going through this paper. Also, just a quick heads up, this is going to be quite a long episode. So I'll leave timestamps in the description so that you can jump to any section which you think you may get the most value from. And as always, we just want to make it clear that we are not professional investment advisors. So if you want independent financial advice tailored to your own circumstances, then seek that from a professional. And with that, make sure to get yourself a hot beverage or a can of lager. I don't judge. Sit back and enjoy. Let's get into it. Asset allocation, cost-effective implementation, rebalancing, behavioural coaching, asset location, withdrawal order for portfolio spending, total return versus income investing. These are 7 modules that Vanguard identified as areas where financial advisors can add value to their clients. These modules were highlighted in their 2019 paper, Putting a Value on Your Value, Quantifying Vanguard Advisors Alpha. After creating the Vanguard Advisors Alpha in 2001, where they identified different areas where financial advisors can add value to their clients, they finally decided to put a quantity to that value. They believe that Vanguard Advisors Alpha's framework can add up to 3% net returns for their clients. This of course can vary massively from client to client, based on their past experiences or financial circumstances. But still, 3% is huge. This table shows all of the 7 modules, with their respective typical value added in basis points. Just remember that 1 basis point is 0.01%. So 100 basis points is 1%, and 40 basis points is 0.4%, and so on. As you can see, the value added varies massively from module to module, with some being as high as 1.5%. For the values that are stated as larger than 0%, the value is significant but is too unique to each investor to quantify. So, with the aim to make us all better investors, we're going to go through each of these modules one by one. We're going to discuss some of the key considerations for each module so that hopefully you can get thinking about some areas of portfolio management that you've never thought about before. Of course, some of these modules are going to be complex, and realistically, each module probably deserves a video to itself. If that's something that you'd want to see, then just let us know in the comments. But for now, a brief overview of all of the modules is going to have to do. Module 1, Asset Allocation, earning anywhere above 0%. Now remember, this value is not quantified precisely. It is significant, but it's too unique for each investor's personal circumstances. Ultimately, this comes down to making sure that you have a clear financial plan with some set financial goals that you can work towards. With this, you can build an asset allocation to help you work towards those goals. Setting financial goals is pretty easy to do on paper, but it's a key part of financial planning that people tend to skip over. Examples of some financial goals would be to purchase a home within the next 5 years, or say to be financially independent by the age of 50. These goals are going to vary massively from person to person, which is why it's key to ensure that your financial plan is tailored directly to you. Once you have a set of goals defined, you actually have an investing purpose. You can use this information to determine your investment horizon, that is, how long you're investing for, and then also your risk tolerance. And then you can use that information as the foundation for the portfolio that you will build. For example, let's say that you have a lot of short-term financial goals that you want to achieve within the next 5 years. With such a short investment horizon, it's likely that investing in 100% equities may not be suited to you, as a market crash could ruin your plans. However, if you have no short-term goals and you have a good tolerance for risk, then 100% equities could be right for you. This emphasizes the fact that there is no perfect portfolio, as different portfolios will work better for some people than others. In the paper, Vanguard then goes on to explain the effectiveness of simple portfolios. That is, long-only equity and bond portfolios. They explain that you don't need a complicated or sophisticated allocation to achieve good long-term results. To demonstrate this, we compare the performance of endowments versus a standard 60-40 long-only portfolio. They emphasize the fact that endowments are run by incredibly talented professional staff, so they should be difficult to beat. Yet, the data shows otherwise. The 60-40 portfolio holds its own. This table shows the performance of small, medium, and large endowments, as well as a 60-40 portfolio, over 1, 3, 5, 10, 15 and 30 year periods. Over the 3, 5 and 10 year periods, the 60/40 portfolio outperformed all of the endowment types. But for the other time periods, it did trail some of the endowment types. Nevertheless, that is still a pretty positive result. As Vanguard puts it, simple is a friend, not a weakness. Not only is the 60/40 portfolio much easier to manage, it would also cost much less to implement. Speaking of costs, that takes us right onto the next topic. Module 2, cost-effective implementation, earning 0.34%. Now this one, as you know, is simple. Invest in low-cost funds. Unfortunately, the industry is quite saturated with passive ETFs and index funds. There are so many options available from so many different providers. But the truth is that some of these ETFs and index funds literally do the same thing. So we need to make sure that we're not paying a high price for an ETF or index fund that we could get elsewhere for cheaper. This table shows the asset weighted expense ratio for different portfolio types compared to the lowest fee options available. Across all portfolio types, investors pay an average of around 0.3% more than the cheapest option available. The effect is more dramatic for portfolios with a higher equity allocation. So the advice on this one is simple, and I feel like I've told you 1,000 times. Invest in low-cost funds and keep more of your money in your pocket. Module 3, rebalancing, earning 0.26% in risk-adjusted terms for a 60/40 portfolio. Now, in a sense, this is linked to Module 1, which is all about ensuring your portfolio links up to your investing needs. But this module is all about rebalancing that portfolio to ensure that it maintains the set allocation and continues to reflect those investment needs. If you invest in a 60/40 portfolio, then it makes no sense to let that allocation slowly drift towards equities, as it will no longer match what you initially wanted. Typically, stocks outgrow bonds in a portfolio. So if you don't rebalance, you could get to the point where the stocks grow so much and they just start to dilute the bonds that are in your portfolio. This graph shows a 60/40 portfolio which is not rebalanced in blue, and one that is rebalanced in green. The y-axis shows the equity allocation, which of course starts at 60%. The rebalanced portfolio follows a relatively straight line over the 50-year period, whilst the unbalanced portfolio begins to drift, slowly increasing in equities. This is because the stocks are outgrowing the bonds, as they start to take up more of the portfolio. Although this may be better for long-term performance, your risk profile will not be properly set. The aim of rebalancing is to minimize risk, not maximize returns. However, rebalancing does have the automatic effect of selling high and buying low. Let's say you have a 60/40 portfolio and the equities do well in a certain year. When you go to rebalance, you're going to have to sell some of those equities because they've outperformed. So inherently, you're going to sell the equities at a high price. Alternatively, if equities performed poorly in a certain year, you would have to buy more equities, which would be at a low price because they didn't perform well. So by rebalancing frequently, you're buying low and selling high, which is great and actually helps your performance. Module 4, behavioural coaching, earning between 1 and 2%. Now this module is deemed to have the most significant effect on returns, but of course it varies a lot from person to person. This is all about sticking with your financial plan, maintaining a long-term approach to investing, and cancelling out short-term noise. As investors, it is key that we don't make irrational decisions based on emotional responses. What the market does over the course of a few weeks or a few months should not make you stray away from your long-term financial plans. Vanguard shows some data from a recent study where they compared the performance of some self-managed investing accounts to the performance of their target date funds over a 5-year period. The results show that accounts that made no changes to their portfolio trailed slightly on average, which was mainly explained by fees. However, accounts that changed their portfolio even just once trailed the benchmark target date fund by 1.5% on average. So have a plan, pick some funds, and stick with them. After that, they describe a study that showed investor returns compared to the fund that they invested in. Investors trailed their funds across the board, but more particularly in fund categories that were concentrated and different from the overall market. This shows that investors tend to struggle to keep up with fund performance, likely due to behavioural investing mistakes. The behavioural mistakes were even more prominent when the funds were different to the overall market, as these plans are generally harder to stick with during the hard times. This data just shows that we can damage our returns without even knowing it. Too many transactions or too many portfolio changes can eat away at our returns. By making sure that we stick with the plan that we initially set, we can expect the best returns. Module 5, asset location, earning up to 0.75%. Depending on bucket size and asset allocation. Now this section is related to the breakdown of assets held within non-taxable and taxable accounts. It's all about making sure that your taxable assets are placed in the most optimal location. so that you pay as little tax as possible and earn greater returns. The key is to place the most tax efficient assets, such as index equity, in taxable accounts. Then you can place the assets which you will pay more tax on in your tax deferred accounts. The paper includes a table which shows some asset location examples for a 60-40 portfolio. Row A shows the most optimal asset location, with index equities in a taxable account and the rest held within tax-deferred accounts. The pre-tax and after-tax returns can be seen in the right-hand columns. As you move down the columns, each asset location becomes less optimal, and the after-tax returns decrease. So the key takeaway here is just to make sure that your assets are placed in the most optimal location for tax purposes. This definitely requires a little bit of research or know-how, which is where a financial advisor would add a lot of value. But more on that later. Module 6. Withdrawal order for clients spending from portfolios, earning up to 1.1%. So, you've been investing all your life and you've built up a portfolio and it's time to retire. As you stop working, you'll likely have to withdraw from your portfolio to provide income. So this module is all about withdrawing from your portfolios in the most optimal way to ensure that you pay as little tax as possible. The withdrawal order can admittedly be quite complicated, as there are 3 different types of accounts that you invest in. We have general investing accounts, or GIAs, that are taxable. We have pensions that are tax deferred, and then we have ISAs, which are non-taxable. This paper is US based, but I'll still share the optimal withdrawal order nonetheless. The paper suggests withdrawing from RMDs first, then cash flows on assets in taxable accounts, then taxable assets, and then tax-advantaged assets. Of course, the US tax system works differently to ours, but you get the point. By withdrawing from our portfolios in the most optimal order, we can increase our returns without taking on more risk. This figure in the paper shows the order in a concise format. However, I would recommend discussing this with a financial advisor, as this is where they can certainly add value. Module 7. Total return versus income investing, earning above 0%. We've actually got a video coming out on this topic soon. But the main point is that bonds may no longer be viable. As investors approach retirement, it is common practice to reduce equity exposure and increase your exposure to bonds to reduce volatility. However, with bond yields being so low at the moment, investors are struggling to get the required cash flow to fund their retirement. This income investing approach may no longer be viable. The paper discusses 3 different types of income investing, as well as their flaws. Number 1 is moving towards longer term bonds to try and increase your returns. Whilst this could increase a bond yield, it would also increase the sensitivity to changes in interest rates. Generally speaking, the longer term the bond, the greater the fall in prices when interest rates climb, or the greater the rise in prices when interest rates fall. As interest rates are currently so low, it seems that they're only going to go in one direction, and that's up. But more on that in another video. Number 2 is moving towards higher yielding bonds, which have higher credit risk. Whilst again, this would improve returns, it would also significantly increase the amount of risk that you're taking on. The idea of investing in bonds is to minimize risk, so this isn't necessarily ideal. Number 3 is increasing your exposure to dividend paying stocks. Dividend investing is certainly a common investing strategy, but it also has its flaws. One major flaw is the reduced diversification that investing in dividend-only stocks offers. Around 50% of stocks in the world pay dividends. So if you're going to invest in dividend-only stocks, you're reducing your diversification options by about half. Not only that, but equities are more risky than bonds, even if they are dividend stocks. Remember, the goal is to provide a stable income for retirement, so increasing equity exposure may not be ideal. However, Vanguard suggests that income investing may not be the solution, and that we should focus more on a total return investing approach. This would mean sticking by your globally diversified equity portfolio even during retirement. Whilst many people may think that bonds are necessary as they reduce risk, this may not be entirely true. Not only are bonds less efficient than index equities, they also have lower expected returns, which increases the risk of us not achieving our financial goals. Vanguard summarizes that sticking with a total return investing approach has the following benefits: less risk, as it allows for better diversification, better tax efficiency, as it only includes tax efficient assets, and finally, a potentially longer portfolio lifespan. So perhaps we should question the norm, and maybe sticking with equities during retirement could be a positive thing. So that's an overview of the 7 modules that Vanguard highlights in its paper. As a reminder, we have asset allocation, cost-effective implementation, rebalancing, behavioural coaching, asset allocation, withdrawal orders, and total return investing. Hopefully, at least one of these modules may include some information that you have not considered before. But realistically, this information needs to be more than considered, it needs to be implemented. Is this something that we can realistically do as amateur, part-time investors? That's not something that I can answer. But I am certainly going to tackle that topic in a follow-up episode to this one. We're going to discuss whether or not paying for financial advice is worth it. So make sure to subscribe to the channel so that you don't miss out on that video. And also drop a like if you learned something new today. As always guys, thanks for watching.